Afternoon, everyone. For those of you that do not know me, I'm Colin Day. I am a financial advisor with Correct Capital Wealth Management, and you are all on this call because, because our ill-fated previous attempt was undone by the AWS server confusion of a week ago, I think at this point, 2 weeks ago. So I apologize if you were on that particular presentation. As you can tell, I decided to remove the presentation off our server so I would have it available just in case we had another tragedy like that before. But for those of you today that are joining us, majority of you, if not all of you, are participants in one of our 401k plans across the United States. And so this particular presentation is being recorded and will be distributed back to the powers that be at your firms. So if you do have to leave for whatever reason, or would like to pass this along if you feel the information is applicable to a coworker or something like that, a recording will be sent out in a little bit. So because this is going to take about 20 to 25 minutes, I'm going to just jump right into the presentation. Again, if you've joined us in the past, if you have questions, please reserve them until the end of the presentation. That'll be the easiest way to get those that want the information off the call as soon as possible. Again, this will be recorded later. If you prefer to type them in the chat, I will try to address questions that are pertinent. If not, I will address them at the very end. So without further ado, inflation in interest rates. So, depending on where you are in your working career, in your lives, for that matter, inflation and interest rates might have an interest to you to some degree, but it does matter to investors. And so we're going to start there in our presentation. We're going to talk about how things like inflation has changed over time, the new reality for interest rates as we go forward, and as we think of our composition for our portfolios, and how we can use this new information to become a better and more informed investor as we all approach retirement. So again, some of you on this call might be very close to retirement, others might be very far away from retirement, but I think there's something that everybody can collect from this information, and again, we'll address questions at the very end. So we'll start with inflation, what I call a battle of attrition. So inflation, just to define it, is a decline in the purchasing power of money. I've got money in my pocket. If I keep it there for a number of years, it suddenly becomes less valuable because the world has changed. It has increased the prices on goods and services, and they become more expensive over time. So generally, this occurs when money supply outpaces economic demand. So for those of us that are living through this current time, you might know that we've got an influx of money out there. Savings rate has been very good for the first time in a very long time for Americans, and part of that has to do with stimulus money. So right now we're seeing an increase in inflation, and we'll talk more about the actual numbers in a moment. And just to mention it, the Fed, the Federal Reserve Bank, is working to keep inflation in check. And they have certain things that they're able to do so. Just know that they're wanting to maintain inflation to be about 2%. So what's making inflation worse? So I just mentioned federal stimulus. People, being reluctant, unable, or unwilling to return to work can also have an impact on inflation because the unemployment rates, as you can see over on the right, kind of went through the roof during the pandemic and really have not gotten back all the way to the pre-pandemic lows. Of course, we've got the fund supply chain issue, as this picture depicting all those barges out there, maybe at the Long Beach or in Los Angeles, just waiting for things to come by, meaning there's fewer goods and services for all to buy, so jacking up prices. And then, of course, reducing energy production. So referring mostly to the OPEC states out in the Middle East, you're dealing with drillers or organizations that didn't see much travel in 2020, and thus they're trying to recoup some of their losses. So they're maybe going to hold back on production, requiring then those governments that hold on to reserves to try to release them to relieve pressure from us purchasing gas at the pump. So how has inflation changed over the years? So, and I'll be honest with you, this presentation is full of these types of slides where there are lots of fun graphs. If you are interested in getting the PDF, just send me an email. I'll be happy to send it over to you. It's just a lot. I'm going to gloss over a lot of things too, because we have a lot of material to get through. So how has inflation changed over the years? So if we take a look over here, we can kind of see this orange line. This top line up here is the annualized rate, whereas the red is the month by month change. And so as we can see here during the recession, 2020, we can see that the inflation rate actually declined and then greatly inclined and then has remained steady. Actually saw a decline in the fourth quarter, but then it was actually coming right back up. And so because we've had a series of months where it's been closer to that 1%, that's why we have this huge tail up here coming to 6.2% in where we are right now. I believe this is as of the end of the third quarter, so September 30th. A little bit different chart. Unfortunately, it's a little bit blown up, and so it looks a little bit weird. But the information here is good because it's basically taking by decade what the average annual inflation rate is. So if we can come back here, we've got 9.8%, terrible volatility out here. We take a look at very low inflation rate or negative rates in the 30s during the Great Depression. But most of the time, when we think about long-term averages, this is why so many financial advisors use the 3% rate to talk about inflation. But the reality is that if we look at the 90s, the 2000s, and then the teens, we've been basically hovering somewhere around an average about 2.5%, or more recently, let's say in the last 10 years, it's been less than 2. So the Fed has actually been doing a very good job of keeping inflation rates low, but that's also why when we see inflation rates at 6.2%, 3 times what we've been seeing over the past couple of decades, this is why so many people are getting concerned. And talking about concerns with inflation rate, not all goods and services rise and fall in terms of their price evenly. So you can see on this goes back to 1982 to 2020. This chart depicts average inflation by spending category. So healthcare, education, very common ones that are a higher inflation rate. Normally when we work with clients, we say that, let's anticipate healthcare and education going up at least 5% per year. If we come over towards the right, we can see other kinds of goods are not as affected quite as much in the same in that same way. But, again, going back just one slide, so over here, this is going all the way back to the 1980s when inflation was much higher at 5.82%, again, tapering down over the past several decades. We can see that, basically, from housing over, we can see that's been generally a much lower inflation rate. So things like affecting, how much it costs to get, food and beverage. So going to the grocery store. So buying a can of pop or soda is not the same as, trying to afford your kids' education expenses over time. So let's switch gears. We've been talking a lot about inflation. We're going to talk about interest rates now, and how interesting they might be for us. So again, just to define it, we're going to say that interest is a return on investment paid by debtors to creditors. So whether it's in the form of you taking out a short-term loan on your credit card to be able to buy something, or whether it's your mortgage interest, your auto loan interest, whatever it might be, that's what we're talking about. So interest rates will generally be the inverse of inflation. So again, if inflation's going up, generally interest rates go down and vice versa. Part of that has to do with what the Fed is doing on the back end that we can't see. But what they can control is what's called a federal funds rate, and which is an overnight bank lending rate to make sure that banks have minimum amounts of money available at any given time to lend out to their clients. So this rate, they can increase and decrease, and what that does is it will either trigger other interest rates to increase and decrease. So I'm painting with a wide brush here, but this is the semblance of an idea as to what this does. Right now, just to give you an idea, this is as of November 18th, the federal funds rate was 0.08%. So it's very, very low. Historically speaking, if we take a look here, since 1954, you can see how that's fluctuated over time, the 1980s being a time when the rate increased dramatically. But after the Great Recession in, we'll call it 2008, we could see that that rate was remaining very, very, very low. And it was only until recently, pretty much at the end of the Obama years into the Trump years of the presidency, that we were starting to taper that back up. And then again, we had to release that emergency valve and go back to 0%. Again, this just tries to facilitate more money being available to lenders or to debtors to be able to borrow money from banks and try to get more money out there than into the economy. So how low can you go, or in this case, the banks row? Well, if we look at the 30-year Treasury rate, so we're talking about now the federal government and lending out, in this case, a 30-year bond, we can see how the rates have tapered over time. And this becomes a major concern when we think about retirees and focusing more on conservative investments, so like the bond investments that might be available or the stable value or fixed accounts available in your respective 401k plans. there's a constant worry that, well, I mean, the type of portfolio that we used to suggest maybe 20 years ago to individuals in retirement can't be the same as today because interest rates have fallen dramatically, which then means our assumptions have to assume that your investment returns won't be as great, which then affects some other things that we have to do with retirees. If we look at the U.S. Treasury yield curve, which is just the basically how we look at short-term lending or short-term interest rates compared to long-term rates. So if you're going to get a 30-year bond from, or basically a Treasury bond from the Department of the Treasury, you'd get somewhere around 2%. This is as of October 2021, so this is a little bit out of date. But you could see that if you're just trying to do something in the short term just to try to get some interest, you're basically getting next to nothing. Your local bank can likely provide you with a rate a little bit higher than that in a CD right now. But it just tells a story that those people that are concerned about the markets are concerned about putting their money in the right types of places, even in short term, just because they're nervous about the market. There really is nowhere to go to try to achieve anything that will achieve then the 6% inflation rate that you might be experiencing on an annualized basis. So again, why does this all matter? So when we think about interest rates and inflation, why are we worried about all this stuff? And then what can we do about it? So first of all, when we think about those approaching retirement, when you become more conservative with your investments, we focus less on the stock side of things. We focus more on what we're going to call fixed income or bonds. So if we focus more on this area because we're nervous about the market, this money becomes very real. We need to start to spend this money. We need to make sure that we have cordoned off a safety net, so to speak, that's available to us in a moment's notice so that if something bad happens over here in your stock portfolio, we have something to fall back on. So when we look at this bottom bullet point, if any of you have read anything from Morningstar or really anything in theory in regards to what you should be doing with your pot of money once you do retire, many financial advisors use as kind of a starting point is what's called the 4% withdrawal rule. So if you've got $100,000 or let's say $1 million, tucked aside for retirement, just to use a more realistic figure. So that means if I can only withdraw 4% a year and have sustainable income without running out of money over a 30-year retirement, I can take $40,000 a year. So basically this came about by somebody, I believe it was a financial advisor, who just did some basic research to figure out, okay, let's go all the way back through the Great Depression, through when markets were being tracked. And if I was to retire in any period, any 1-year period, tracking for 30 years in retirement, is there any period where I might run out of money? So if you retired in 1919 and you wanted to live to 1949? So your 30-year retirement spans that period, then do I run out of money going through the Great Depression and out the other end if I take 4% per year? Okay. And so then they say, well, what happens if I retire in 1920 and go to 1950, then 1921 to 1951, et cetera, and so forth throughout time? And what's come about now is because of the kinds of diversification that we can do then in the portfolio, it's from this brand new research, this just came out a month or two ago, they're actually considering lowering that 4% rule to 3.3. And this is a direct result of interest rates where they are and new concerns over inflation. So what this is to say, why this matters is that if, again, we are considering with our clients how we're supposed to diversify your money over time, over a 30-year retirement, or at least a hopeful 30-year retirement, we have to be conscious about how we diversify to make sure that this money lasts. So lots of fears, lots of interesting stuff, in terms of inflation rates and interest. And we're going to talk now about how do we combat this then. So what are our 3 considerations? So number one thing that you could probably do is diversify your fixed income holdings. So what I mean by that is, you have different kinds of bond or fixed income investments available in your plan. All of your retirement plans are a little bit different in terms of what is available, but something like what you see on the screen there is probably available in your program that you can diversify to. So things like high yield bond funds, multi-sector bond funds, core immediate bond funds, all those that are there, all do something different. So when we say to somebody that it's very common that you'll have a 60-40 portfolio when you retire, what we actually mean by that is that about 60% is in the stock market, and that's diversified to a bunch of different equity instruments, like in the international market, developing markets, U.S. markets of various sizes. But then that other 40% that we say is in fixed income That's going to be divided between a lot of those bullet points right there. It's not just meaning we're going to put it all into one bond fund. We might need to utilize different kinds of instruments within your portfolio because all of them do something a little bit different. So for example, what this is showing here is various kinds of portfolios with a 4% initial withdrawal rate. So going back to that 4% withdrawal rule. So the green line is 100% in cash. So if you are completely fearful of the market and you put 100% of your money in cash, it's very likely that you won't make it a full 30 years in retirement if you start off with $1 million. Okay, $1 million, 4% withdrawal rate, gets you somewhere around 23 years. Now, if you put yourself into a portfolio like this middle one here, which is the gray line, the middle one, it could get you to 30 years. And what this is basically showing you is a 40% that's in what's called the All Country World Equity Index, and then 60% is in US aggregate bonds. So this is actually the opposite of what I mentioned before. This is actually 60% in bonds, 40% in the stock market. And then this top line, this purple line, which obviously is depicting the more rosier outlook for this individual with $1 million at a 4% withdrawal rate, is a more diversified portfolio. And you can see all the different investment options and their reflective percentages there. So again, thinking about interest rates just for the moment, we're looking at down here, we've got US investment grade bonds, we've got US high yield bonds, which is just a polite way of saying junk bonds, and then also emerging market debt. So in this kind of portfolio, being a little bit more intentional and diversified throughout the portfolio, as opposed to just relying on a couple indices, we might achieve greater results through diversification. So number two, this is more of this isn't so much a quantitative thing that we can control, but this is a subjective thing that you can control as an investor, and that's to get more comfy with risk in retirement. So the reality is that it's very, very rare that anybody will put 100% of their money in cash. I think there might have been a time I used to work for a large insurance company, and they offered a fixed rate of return of 3.5%, if you could believe it. This is within the past couple of years. And many people would feel completely comfortable putting 100% of their money there. But unless you had the money in the account already to be able to sustain yourself, to have the 3.5% return and a 4% withdrawal rate, it's very, very rare that anybody's going to say, put it all in cash. Again, you would have to be sitting on oodles of money and have just no risk tolerance at all. And so that's why we would encourage you that you're likely going to be at some kind of greater amount of risk than maybe what you perceive that you would be in retirement. And it's that idea that it's not because we're doing something as advisors that is trying to convince you to do something more aggressive because it's what you should do. It's the reality that we must do it to be able to facilitate your retirement and your spending habits over time. So what this is showing us here, and this is from Fidelity, is this is a chart showing all the different kinds of portfolio returns depending on how you allocate your funds over time. So if we think about rising costs, so in this case, they're estimating inflation at 3%, like we talked about a moment ago. They're putting healthcare costs rising at about 5.4%. And I think they're looking, not sure what time period they're looking at for that 5.4, but let's go with their assumption because it's an assumption that we would actually use. If you take a look at average annual portfolio returns based on investment allocation, so that 5.96% in the conservative portfolio, if we peek back behind the curtain, we would see that 80% is in bonds and 20% is in stocks. Whereas on the complete other side of the chart, we've got the aggressive growth portfolio, which is 85% stocks and 15% bonds. So much more higher allocation in bonds, and you can kind of see how that's performed over time. So one would think that, if I've got healthcare cost concerns and I'm making a 4% withdrawal rate, the conservative portfolio makes a heck of a lot of sense, Colin. I'm going to earn about 6%. Problem is that this is a historical average going over periods of time we just looked at where interest rates are much different. Inflation rates are much different. So if the new reality is that maybe inflation is a little bit higher than what we previously assumed, and interest rates are going to trend lower, that 5.96% year over year is probably going to continue to decline unless the stock market, which is again in that conservative portfolio, only 20%, does really, really well. So again, is this battle of always making sure that we've got the level of risk that is appropriate over time and making sure that we're making good educated decisions. And another way to think about this is by kind of this this equity approach or this bucketing approach of how we distribute our accounts. So which is to say that many of you on the call might have majority, if not all of your retirement money saved up in your 401k plan. And if that's the case, that's fine. It's just understanding then how you diversify within the account, the growth, the maybe we'll call it intermediate term, and then your more immediate cash needs. So what this is basically showing us is that, if you've got a longer term outlook, we can be more aggressive. So you can kind of see how that breaks down much more in equities, which is the blue. So that's the stock market portion. We can see how it decreases as we get to more intermediate term needs. And then as we get closer to those short-term needs, we get into cash. So what we might say to somebody who's approaching retirement, maybe they're about a year out or two, we might say, okay, what will keep you up at night in terms of not having in your checking account? So if you tell me, Colin, I need to have $20,000 in my checking account at all times so I can sleep. Fine, we start there. We make sure that, if it's all in your 401k, we have that kind of money in like a money market or fixed account in your 401k plan. Then after that, if we think, okay, within the next couple of years, let's say 5 years or so, we'll look at intermediate needs. We're going to deplete this bucket eventually because you're going to spend from your 401k. So we're going to start to invest intermediately in this account, a little bit less risk than your growth account. And over time, as this gets depleted with your spending, we're going to put this money into here. So we're going to make some cells in your account to be able to put it over here. So this might be mostly bonds or all bonds, but this is our intermediate term. And then mostly equities is over here in the long-term stuff. And so this is the stuff that we don't really anticipate needing over long or until a much longer period of time, maybe 10 to 15 years. So it's a way of saying we've got growth and more aggressive stuff on one end of the spectrum. We've got an intermediate term expense or investment account, and then we've got the short-term stuff for your immediate spending and expenses. So over time, this bucketing approach, we're pouring water from one bucket into the other as this one gets depleted. This is a more healthy way to think of your account and diversify and handle risk, as opposed to just saying, again, I'm going to put it all in bonds, I'm going to put it all in cash once I get to retirement. So last one, delay Social Security if you can, which if you've attended any of my presentations in the past, you might have heard that, just delaying Social Security isn't going to be the answer to everybody. This is a very subjective thing. You can elect for Social Security as early as 62. You can delay all the way until 70. The longer you wait, the greater your check will be. If you haven't looked at your new Social Security statements, they're trying to depict that idea a little bit more fluently by providing you with a chart that literally shows you how delaying your check increases what you get over time, so you can make a better educated decision. And of course, if you wait past your full retirement age, which depending on your age on this call is either 66 or all the way up to 67, it gives you an 8% return by delaying. So many people will choose to delay because it gives them the biggest check. Now, while cost of living adjustments have lagged behind inflation, some of you may have seen the big increase that's coming to Social Security checks. At minimum, what it's doing is it's giving you guaranteed income. So when we think about, again, that allocation we were talking about on the previous slide, this is something that we can play with that then determines and gives better results. Just because of time, I'm not going to go through this particular slide, but what it's trying to depict is, by delaying, you get that 8% per year. So if your full retirement age is 66, you can get up to 132% of your full retirement age benefit, 124 if your full retirement age is 67. And by electing for it early, it decreases your benefit. But again, if you need these slides, you can just email me later. And again, I'm not going to go through this one either, but it does show you how by delaying your Social Security benefit, you can get an idea as to where your break even is. More or less, the break even is somewhere around 13, 14 years from your delayed year. So if you think that you're going to live well into your 80s, it probably makes sense for you to delay your Social Security as late as you can, as long as financially that makes sense for you. Okay, I lied. I said there was only 3. We're going to do one bonus one. It's contributing early and often to your retirement accounts. Could be your IRA, it could be your 401k, could be something that you do on your own. It could be you, could be a spouse, whatever it is. It's very important to understand that the biggest driver for success is not your investment performance, but regular contributions to your account. Because while you can perform and earn 20% per year, and that'd be great, if you only have $100 going in every check for your entire career and you make $100,000 a year, it's not going to be adequate enough to be able to replace the income that you need over time. And then as you contribute, you need to make sure that you increase your contributions And then if we want to take a quick look at an example, we've got Megan and Jason. So they're both the same age, they're both 35. Now, Jason is going to delay his contributions. He's got some other stuff that he wants to work on right now, whatever that might be. He's going to wait until 45 to start electing his contributions, whereas Megan's going to start right away. Now, they're both going to contribute $100 a pay. So again, Jason's going to start doing that 10 years from now, but Megan's going to do that today. They both plan on retiring at 65, so they've got 30 years to go. So if we can see over time, as an average return of 7%, which I think is feasible over the long term for both of them, we can see that Megan gets about $122,000 into her account. Because Jason delayed 10 years, he only gets $52,000. So Jason's original scheme here was that he was going to wait 10 years and then he was going to be super aggressive with his investments. And that was really his hope. So to be able to match Megan's amount, which she accumulated over her 30-year working career with that 7% return, he would actually need to earn 13.5% per year to reach Megan's account balance at 65. So this is really just to say, does Jason really feel like he can earn 13.5% over his working career? And can he support that level of risk tolerance to be able to save that kind of money over this time period? And so he has to make that decision as to whether or not it's appropriate for him to delay, as opposed to Megan, again, who was able to decrease risk over time, maybe take the amount of risk she was comfortable with and not stress out over market conditions, interest rates, inflation over time. So contributing regularly, contributing what you can, generally results in a better outlook and outcome for the individual. Okay, I went a little bit over and I apologize. There was a lot of information on those slides. So again, if any of you would like them, please just send me an email. I'll be happy to send them to you. I'm at Colin@correctcap.com. John actually took the day off today. He would normally be on these calls as well. He's another resource for you. Again, together we are financial advisors that work on your 401k plan. If you have questions outside of your 401k plan, feel free to reach out to us. We'll be happy to schedule a separate time maybe to discuss that. But if you do have any questions, I am here now. You can feel free to type them in the chat, or we're a small enough group again, you can unmute yourself and ask anything you got. I'm going to take a quick water break. Any questions? I know it was a thrilling topic, so if you're all exhausted, I understand. And if any of you have questions or commentary in regards to this presentation, or would like to give some ideas in regards to what you'd like to hear in the future, this is your meeting. So we do this again every quarter for our 401k participants, and we had lots of people registered for the first one. Fortunately, we had to cancel again. So this is a smaller group. But if you do have particular topics that you want us to address, either with your company-specific education or in this group setting with all participants, you can let me know. Thank you, Jim. All right, wonderful. Okay. Last call for questions. All right. Thank you to everybody who joined. Again, I'll be sending out the recording to the person that probably put that in your inbox in the first place. So if you do want to watch a recap, if you do need the slides, feel free to let me know. Okay. Thanks, everybody. Enjoy your day.